Welcome to module number 2 of the financial literacy course. This module is allocated and dedicated to understanding banking. So we're going to take a reasonably foundational view. We're going to start from the very, very basic concepts of what constitutes a bank and what they actually are for and how they work, so that you understand a little bit more about what banking is available for you, what banking services should I say. So let's look at the content, and I'm going to switch over to our slide view, so that you can see what we're looking at. And first up, we're going to talk about what basic services the financial institutions actually offer. What are they actually giving you as an option to take up as a service? And then how do you know what the right type of bank account to choose is? So there are things like check accounts, savings accounts, credit card accounts, debit card accounts, lots of words that they use. And it can be a little bit complicated working out what you actually need versus what they say you should open. And bear in mind, they have an incentive to offer you the things that they think are valuable. So you want to be aware of what the offerings mean and why some of them are useful and some of them are not. The next point will be on the rights and responsibilities that you have when you interact with a financial institution. They have certain commitments that they make to, in terms of legislation. They have to agree to certain things, and you have certain responsibilities as a consumer to actually know what your rights are as well. And we'll look at a little bit about how to keep your account safe and what to do if you think someone may be using your account illegally. This is like a hack attempt, or someone's taken over your account in some way. It's possible, so we will cover that off so that you can stay safe when it comes to your banking. So let's talk in terms of banking as a basic concept. Many people don't get exposed to this. Their parents kind of take care of their money, and some people, when they're young, their parents take them to the bank and open up an account when they're a child, and that's their first interaction with a bank. Nowadays, as banks have become more digital and they become more mobile, that may not be the case. You may just go to a website and not actually know that there's a brick and mortar institution or a company. Some people have not been to a bank branch for any specific reason. Many things you don't need to go to a bank branch anymore. It wasn't always that way, but with the advent of mobile phones and apps and web banking, you're able to do a lot more. And some people, obviously, if you need cash, you can draw it at one of those automated teller machines. So we'll cover off a little bit about that. So it's not uncommon to get a bit confused by what the various types of accounts a bank offers are. So with that, the section we're talking about here is the basic banking services. I'm going to talk about deposits, some card services, and how the deposit insurance system is designed to keep you safe, and then how banking, how to use banking services for your everyday needs. So when I mention banks, what I'm actually talking about are banks and credit unions. If you're in Quebec or the Francophone provinces, Francophone areas of Canada, you'll hear the term Caisse Populaire. It's basically the equivalent of a credit union. It's like a cooperative bank. It's not owned by a big organization. It's actually all of the members get together and own a portion of the organization. So when you open an account, you actually buy shares in the cooperative. Different to a bank. When you open an account at a bank, you don't get shares in a bank. And then there are trust companies and various other entities depending on what services you may need. So you're able to get deposit services. This is where you will put money that you have with the bank or the credit union, and they will keep that and pay you a small amount of interest on it. They'll pay you 8% amount of interest, and they will keep your money safe, as opposed to if you put it under the mattress at home or you put it in your piggy bank. The next piece is card services. When you go out into your life and you want to purchase something, having a plastic debit card or credit card is very useful. So for the sake of this, I'm not going to go into credit cards. We'll cover that in a later chapter. I'm talking about debit cards, where you can draw out of your existing account, not spending on credit, but where you're actually using a card to access your money. So you could go to an automated teller machine, a bank terminal, and draw out cash on the street. Or you could be in a store and use a point of sale. When you're paying for something at a grocery store, you could use a piece of plastic, the card that they give you, and it sometimes has a chip on it. Sometimes you're able to just tap it, and that will take the money out of your account. But the essential point of this is that having a card is a form of convenience. In the old days, you used to write what are known as checks. Many people don't use checks anymore, but a check basically was a piece of paper where you would write who you were paying, how much you were paying them, the date, and you'd sign it. And then the bank, when they received that, would actually give the person who presented the check the money into their account. So that's what we use card services now to do away with a lot of that. You're able to spend more freely and more conveniently. A loan, this is where the bank gives you money and you have to pay it back, and you have to pay it back with some interest. The longer you have the loan out, the more interest you obviously pay, and the quicker you pay it back, the faster you can reduce the amount of interest you pay. But they usually quote you an interest rate depending on the type of loan. Now you'll get secured loans and unsecured loans. So what I mean by that is a secured loan would be something where you say to the bank, if you give me this amount of money, I'll give you this asset, or this car or this property or some asset that the bank would say, we will take a position with you as a lender, and if you don't pay us back, we get to take that asset. So that's a secured loan. You're securing the loan with some other asset, or collateral is the technical term. An unsecured loan, the bank is just lending you the money without any collateral. So they're taking a chance on you. This usually is only available if you've been with the bank a long time, you've demonstrated a track record of being reliable and always paying your bank interest and your bills on time, and you've got a great credit score. And also if you happen to have a lot of money already with the bank, if you're investing with them or you have a big insurance policy with them, something that would give them a sense of confidence that you are actually going to pay back the money. No bank is in essence lending you money in the hope that you pay them back. They don't run a business with hopes. They actually make sure they're either going to get collateral or they know that they've got some way to get that money back from you. So as benevolent and as generous as the banks may appear, they don't actually work on a hope basis where they just hope you'll pay them back. They actually make sure that they can get that money back. The other piece to note is a lot of the times students get offered credit cards on campus when they're still studying. And banks will have like a little table and they'll give you free baseball caps or t-shirts or some giveaways or something that would incent you to open an account. Now the intention is they want you to take a credit card, or they want you to take some form of loan from them, maybe a student loan, because they think that if you're studying, as you get into the workforce and as you start to earn more and more money, you're actually a really good customer for them. You'll make them a lot of money because you'll bank with them and you'll use their services and whatever they use to make money, that you're a good potential candidate for that. So they'll give you a credit card with a limit, with actually an amount that you can use. And this is a form of a loan. You can spend on it, but a credit card is a very specific type of loan. You have to pay it back or pay a lot of interest if you don't. So you can pay it all off every month, or you can pay off a minimum amount and then they charge you interest. They really like that because then they get to charge you that interest. The point I'm making is, don't think that because you got a credit card as a student that you don't have to pay that money back. You absolutely have to pay that money back, and the interest rates on a credit card are astronomical. It's very high. We're talking 19.99%, or just under 20% is sometimes even higher, 21%, 22% in some areas of the world. So you really want to be mindful about spending on a credit card. It's the highest, or one of the highest, interest-bearing investments the bank can have with you. You're paying a fortune in interest per year. So loans can occur like an unsecured line of credit. You may hear the abbreviation ULOC, ULOC, which is an unsecured line of credit, or a HELOC, HELOC. This is a home equity line of credit, and that means the bank will give you a line of credit. You can lend money, they'll lend you money, you can borrow it from them, and it's secured using your home, or the equity in your home. So if you own a house and you've paid off $200,000 on a $500,000 house, then the $200,000 they will make available back to you in the form of a loan, and they'll charge you a different interest rate than you would on a mortgage. So that's in essence what I mean by loans. And you can also get loans for studying, as I mentioned, a student loan or a car loan. So you can actually lend money to purchase a car. There's lending money, there's a leasing of a car. So there's many other variations, not always from the bank. And there are other services that banks offer. For the sake of this conversation and the foundational elements we're covering, that should be enough to give you a broad understanding. Now let's talk about deposit insurance. One of the benefits of having a bank in your country, especially if we look at USA or Canada, is that the banks have to take out depositors insurance. So they actually have to have an insurance policy that if for whatever reason they cannot pay you the money that you've deposited with them, that you have a way to go and claim on an insurance policy that says, that's my money, I want it back. Now, some people might think, how can a bank go out of business? Or, well, the reality is even banks can go bankrupt or insolvent or basically be unable to operate for whatever reason, and then they're unable to pay you the money that you have on deposit with them. So this deposit insurance is really important because it protects you as the depositor from the bank's inability to pay you back the deposits when you want them, if you want them. So there are different types of deposit insurance. Some of them are federal, they're covered by the entire country government, and some of them are provincial or territorial. So you might have like the province that you live in has a depositor's insurance, or it might be the state that you live in if it's the United States. So when you want to open a bank account, check that there is actually insurance that applies to your deposits. And what I mean by that is if you look at the bottom on the letterhead of a bank or on a lot of their deposit account information sheets, they'll give you like these little fold-out sheets, or if you go to their website and you read on the website, there will be a list of acronyms, and you'll see one of them would be like FDIC or CDIC, and that stands for the Canadian Deposit Insurance Corporation. So there is actually a formal insurance company set up where the banks pay a premium and you then have that insurance. Now, it does have a limit, so be aware of what the limits are. It's not unlimited. It is usually in the order of around, let's say, $100,000. If you have $120,000 deposited at the bank and the bank goes insolvent and goes bankrupt and goes out of business, you can claim up to $100,000. You can't get the other 20. You lose that. If the bank goes out of business, it's your loss. That's just the risk of putting money with a bank. So that's why there's deposit insurance. Now, this is different from if you were to buy a cryptocurrency or some other form of asset where there is no deposit insurance. If you lose that or that's not able to make, you're not able to get your money back, there is no recourse. You can't do anything about that. At least with a bank, you have that ability to claim deposit insurance. So that's an important piece. Very few people realize what that, FDIC, the Federal Deposit Insurance Company, would be the US government's federal deposit insurance coverage. And it also usually covers $100,000 and no more. So you can't claim if you've got $500,000 of investments or whatever, and you ask the bank for it and they say we're unable to pay you because we've gone out of business, you can't claim $500,000. You can claim up to $100,000 and get that. So that's for every account that you open with each organization or banking institution. Now let's look at the ways to do banking and how you would interact with a bank. So financial institutions generally offer you a number of different ways that you can interact with them. You can go into a branch, as we've talked about. You could just walk in and ask to open an account, and they'll deal with you that way. The other way is you could phone their call center and actually deal with them over the phone. Many things are able to be done that way, and you can talk to people, telephonically. They would say to you if there's something they can't do, like they need to look at your driver's license or they need to look at your passport to make sure that you are who you say you are. You have to prove that you are the person you represent yourself to be. This is an important thing for a bank. It's known as Know Your Customer, or KYC, Know Your Customer. The bank has legal obligations to make sure that they didn't just open an account for someone who said your name but wasn't actually you. So if they need to view a document to prove that you are who you say you are, you may not be able to fulfill on that in a call center. But for the rest of the things, pay bills, transfer money, find out why a transaction is not doing what you thought it would, you can usually call the call center. And then there's the more recent, in the last 15 to 20 years, web banking or web browser banking, where you can just go to a web browser and type in your bank's name and then log in and do your banking over the internet. And even more recently, in the last 10 to 12 years, mobile phones and the advent of mobile apps have allowed you to bank on your phone. So the next pieces are not to do with a human being. They're still automated, but it is still something you go to in person, and that's an automated teller machine or an automated banking machine. You'll hear the term ATM or ABM. In some parts of Canada, they use that term ABM. So that's where you go up to the banking terminal. It's usually on the side of a building or in a mall or something. You put in your card, you'll key in your secret PIN, which you're never supposed to tell anyone, And then it'll ask you, like, do you want to draw money, deposit money? And it lets you do a series of transactions or a set of them. Not everything, but it does let you do many transactions. Most importantly, it lets you have access to cash if you want that. And then lastly, the debit card readers. I mentioned that a few minutes ago. If you go into a store and you want to pay for something, you're able to either tap the card that you have on the terminal, and that means you were holding that card and you were at that terminal, so they'll allow you to pay up to a limit, what's known as the floor limit, which is how much can the store charge you before you actually have to put your card in and type in your PIN number. That's that secret code. Again, you're never supposed to share that with anyone. Don't ever give it to anyone, no matter who they are. Even if the bank tells you they need to know your PIN, don't give it to them. You can reset it, but you never give anyone your PIN. So those are what we call point of sale terminals, or POS terminals. You may hear that term as well. And that's essentially the ways that you would interact and deal with the bank. Now, if you think about this from how do I bank for the future, you want to use the bank as a place to keep your money safe, maybe to earn a little bit of interest. Generally speaking, nowadays interest rates are extremely low, so you're not really getting very much for putting your money in the bank. You want to have it invested or working for you. So that does give you that ability. But at the end of the day, the convenience that the banking system affords is basically you can spend on your card, you can pay for things at the movies, at the grocery store, a cab, or an Uber, whatever the case may be. In addition to that, if you consider things like you can automatically transfer money from one account to another, that's very valuable, because when you get paid, your employer will usually want to automatically transfer money into your bank account. So you're going to need to have a bank account. Especially in Canada or North America, many places, they give you a check and they say you can go and deposit it wherever you want and you can do whatever you like with it. But in Canada, in the USA, generally speaking, they like to deposit your money directly into an account. And so you can then set up an automated transfer to a savings account or another form of account so that you build up a way to save for emergencies. So that's very valuable. You'll remember in previous modules, I mentioned pay yourself first. The best way to do that is to set up an automatic transfer. As your salary comes in, sometimes it's twice a month, some people get paid once a week, depends on the job type that you have, but if you're paid twice a month, you can automatically have money automatically diverted into a savings account or some other area where you're going to keep money aside for emergencies, for a big expense, a vacation, a new couch, a fridge, a washing machine, whatever you need to buy. And you can also start saving for long-term investments or some form of longer-term asset growth or something like that. So that's essentially the banking for the future aspect. Use the banks to make sure that you remain disciplined and that you continue to build up emergency funds if you need them, preparing for big expenses. The more money that you put with the bank, the more willing they'll be to lend you money. I know that sounds a little counterintuitive, but that's a little bit of how that works. The bank's not going to lend you money unless they're sure they'll get it back. So that's the nature of it. So we can now summarize this section of the banking module before we go on to the next ones. And I'll leave it at saying that deposit institutions include banks, credit unions. As I mentioned, that the francophone version of a credit union is a Caisse Populaire, and trust companies. Sometimes they're also available to take deposits. And they help you manage your money. They keep it safe. They'll tell you what your balance is anytime you want to know. They'll show you the transactions that come out of your accounts. The main services that most of these offer are taking your deposits. When you earn your money, they'll take it into a deposit account. They allow you cards for convenience, and they'll give you loans if you need it. Car loan, home loan, studying loan, many types of loans. Lastly, the services that they offer are either in person, you can deal with them mobile phone, online, you can even call them. And the main way that most people access cash nowadays is through an automated teller machine, or you have to go into a branch. There's no nice way to get cash. And hopefully with the way the world is moving, we'll be able to move away from cash for the most part, and people will be able to pay each other. Like in the US, you may know a system known as Venmo. You're able to move money from one person to another without cash. In Canada, you may know a system known as Interac. You may have heard of PayPal, and those are ways you can move money between people. So that wraps up section 1 of the banking module, and we can go on to the next section where we'll drill deeper into bank accounts and the packages that they have to offer.